Hello friends, in this video let's examine one more section Income Tax Act which gives some relief to the taxpayer from the burden of capital gain taxes. This section is in section 54F and this section is applicable to individuals as well as Hindu undivided families. Now, the benefit of this section would be available for the sale of any long-term capital asset. But the asset concerned should be other than a residential house. That means any asset other than a residential house is qualified to avail of this benefit. And the benefit is that the reinvestment made in one residential house exempts the taxpayer from capital gains tax. But this reinvestment must be made 1 year prior to the date of transfer of the original asset or within 2 years after the transfer or construct within 3 years after the transfer of the asset. In other words, once the property is transferred, the benefit will be available for the reinvestment made in purchase of another residential house 1 year prior to the transfer or 2 years after the transfer. But in case the taxpayer intends to construct a house, such a construction can take place within 3 years after the transfer of the original asset. Now, to get this benefit, if the cost of the new asset is more than the net consideration received on account of the transfer of the original asset, then there is full exemption available from capital gains tax. Now, net consideration means the total consideration received from the buyer of the original asset minus expenses directly connected with the transfer. But if the cost of new asset is less than the net consideration, then the section prescribes a formula. It says capital gains multiplied by the amount of reinvestment as divided by net consideration. That means a proportional amount is available as exemption under this section. In other words, entire amount of net consideration has to be invested to claim this benefit. Certain restrictions have been placed to claim this benefit. They are: the taxpayer cannot own more than one residential house as on the date of transfer of the original asset. Of course, when I said one residential house, this is other than one new house. That means, suppose the taxpayer has got one residential house and a plot of land. He can sell the plot of land and buy another residential house and claim the benefit of this section. But if the taxpayer has got two residential houses and a plot of land, so if he sells the plot of land, then he cannot claim the benefit of this section. And the new residential house, once it is purchased, the taxpayer should not purchase any more residential house for another 1 year. Okay. And he should also not construct another residential house for a period of 3 years from the date of transfer. Of course, these are other than the new residential house, which attracts the benefit of exemption of section 54F. Now, residential house, when I say, that means it is a house the income of which is taxable under the head income from house property. That means, for example, I have a house and I run a business there. So, if I don't offer this income from the house as income from house property, then the house will not get qualified under this section. And again, the other restriction is that the new residential house should be in India. That means if an SSE buys a house abroad, he cannot claim the benefit of this section. Another restriction is that once a new residential house is purchased, it cannot be transferred for a minimum period of 3 years. What happens if these restrictive conditions are violated? Now let us see the breach of conditions regarding reinvestment. First, capital gains claimed as exemption will be brought to tax. And this will be brought to tax in the year of either additional purchase or construction. Now I said earlier that other than the new house, taxpayer is not supposed to buy another house for 1 more year or construct another house for 3 years. If these conditions are violated, in the year of such purchase or construction, the capital gain which was claimed as exempt earlier will be brought to tax. Similarly, the new house also should not be transferred for a period of 3 years. So if it is transferred within this period, in that year, the capital gain claimed as exempt will be brought to tax. Suppose the construction or purchase cannot be made immediately, then what happens? The Act provides for depositing the amount in what is called as capital gain deposit scheme. This is applicable when the new asset is not purchased either 1 year before the transfer or after the transfer, that is, or within the due date available for filing the return of income. Then the net consideration has to be deposited in capital gain deposit scheme. Suppose I sell a piece of land today. The due date for filing the return of income is in July. So from February to July, I'm not able to buy or construct another house. Then the entire amount of net consideration has to be deposited in this capital gain deposit scheme. On the other hand, suppose I sell a house in February and before July, I spent half of the net consideration for the construction of a house. Then the remaining amount, what I have not spent, will have to be deposited in the capital gain deposit scheme account. Okay. So the amount that is already spent plus the deposit will be deemed to be the cost of the new asset, and the benefit of this section would be applied accordingly. Thank you, friends. That's what I had in this video. In case you have any queries, please leave a comment. Thank you.